Welcome to this very special episode of Investors Guide. I'd like to wish you a very happy Diwali at home. I hope you have a year that's full of prosperity and joy for your entire family. I'm very pleased to introduce to you Rashesh Shah. Rashesh, thank you so much for spending Diwali with us. Happy Diwali to you and to your family.
Absolutely, Faye. Happy Diwali to you, and I want to wish happy Diwali and a really prosperous coming year for all your viewers.
Thank you, thank you. It's of course a time of optimism, and we've been speaking over various Diwalis over several years, and you've always been an optimistic investor. You've always been optimistic, even from the way you approach your business. When you look at where we are right now in the country, whether that's in the way the GDP is moving, the GST is moving, and like we were talking about, job creation, do you remain optimistic, or do you feel that optimism sort of waning a little bit over the last 2-3 years?
See, I think optimism has actually improved over the last 2-3 years. And if you look at India, I mean, in my career of 25 years, if I look back, there has never been a quarter where everything has gone perfectly well for India. If I go back to 89, 90, 91 was the crisis, the BOP crisis. We had the Babri Masjid, Bombay bomb blast, governments falling. Something or the other has always been missing. So in a way, it's to use a cliche, it's glass half full, half empty. But the half full is actually fairly good, because in the same 25 years, the index has given you more than 18% CAGR return, and this is after tax.
Right.
So even just buying the index, complete passive investing has given you more than 18% return. As you know, the index started in 1984 or something, and it was 100 at that time.
Yes.
And the 100 is close to 28,000 now. So there has been a huge amount of growth. I think at the macro level, given where the world is, so in a relative way, and given where India is in an absolute way also, we are as good as we have ever been. I mean, we have never had so much comfort on inflation. Current account, we are almost close to surplus in current account. Government fiscal deficit is under control. Political stability. After 30 years, we got a government with an absolute majority in the parliament. Our government is very, very growth friendly and all.
Are you saying enough of that translates on the ground? And I'll ask you a very simple, direct question for my viewers, and this is what everybody's thinking. There was an optimism when this government came into power that things would change and things would improve drastically. This festive season is very subdued. Inside people's homes, there isn't enough cash, or there isn't as much cash in people's hands as they normally would like to have in Diwali, just for spending. What is your message to the average Indian salaried person this year during Diwali? Are you saying, step back and look at the larger picture, things will get better, jobs will come in? What would you say to someone today on Diwali day?
What we had last 3 years, a lot of urban consumption was growing, but the rural consumption had slowed down because of the rainfall was not good enough. This year, when we talk to a lot of people, we see that the rural consumption is fairly okay, but the urban consumption is slowing down because there has not been as many job growth and all that. Even the IT sector and all, which was a big creator of jobs, has started slowing down. So there is some concern around urban consumption, but I think rural consumption has started picking up, and that will balance it out. Last 2 years, urban was the driver in that sense. The other is, in spite of all that, India will still grow at between 7.5% to 8%. So there is enough growth. And if you look at a lot of the companies are still growing at 18-20%. You look at the private sector banks, a lot of the the mid-cap companies, people are seeing. One of the bigger concerns in India is currently the global situation, because that is affecting us via export growth. It is helping us also because global growth is bad. Oil prices have come down, which has brought down our import bill. But on the other side, our export growth has been very muted. And export growth being muted is not creating enough jobs, because India, in the last 20 years, you look at the kind of jobs that were created in IT and pharma, they were the two leading export sectors. A lot of that is slowing down.
Yes.
Along with that, as the global economy is slowing down, a lot of excess capacity which was export oriented has also got, has also become spare capacity. So currently, if you look at capacity utilization, India is very low. And largely that is not a factor of India's problem, that's a global problem, because we still have about 20% of our economy is export oriented. So when that 20 is not able to grow, no matter how much the other 80 grows, that 20 will act as a drag, and that is what we are currently seeing. But I think in spite of that, India is still growing at 7 or 8%. That is creating opportunities for for people. The good thing is, one is we are not seeing any destruction of jobs. In spite of the technology change, India, we are not seeing destruction. Nobody has, no industry headcount has come down. Growth has slowed down.
Yes, but like we talked about before we started this interview, there is a need to add a certain number of jobs in India every year, given the kind of people who are coming into the workforce. So status quo on the number of jobs is also not good news. If it's good that no jobs are being lost. But no jobs have been created either. It's not good news.
Actually, we are creating some jobs on the skilled side, but a large part of the people coming in, as you very rightly said, are on the unskilled and the semi-skilled side. So industry like construction industry, which takes a lot of unskilled people, some amount of manufacturing like textiles and all, which can take semi-skilled people. Those are getting affected. Textiles are getting affected because of export. Construction, there is just a fairly big slowdown, but I think as the economy picks up, I think another 18 months construction should...
Infrastructure and construction, do you believe infrastructure will also start to move?
It has started to pick up. We are seeing activity in Rome, in roads. We are starting the activity in renewable energy, but the conventional power sector is low. Mining has not come back. Mining is another big creator of jobs. Unskilled workforce gets a lot of job in mining and construction. Those are not growing yet as well. But I think, given the global headwinds, where India is growing, where our own local economy is growing, I'm very optimistic that a year and a half down the line, this will start, seeping down, filtering down, because even the rural prosperity will get translated into overall growth. Agriculture growth will be good. So I think there is growth in India. It's still in pockets and it's invisible, but maybe a year, 18 months down the line, a lot of this growth will start becoming visible also. Unfortunately or fortunately, a lot of this growth will be consumption-led. It will not be investment-led because of the spare capacity. There is not still a lot of room for investments.
So going by everything you've said, so you expect by Diwali next year, the feeling of prosperity would have generally returned?
I would think so. I think the fact that the monsoon has been good, the fact that the pay commission hikes and all have happened will spur some consumption and all that. Plus the capacity utilization, which is getting used up slowly and steadily, will all be positive for that. So even if global situation remains the same and there is no improvement in the global situation, I think a year down the line, at a grassroots level, the feeling of prosperity will be much stronger, as I think it is now as compared to about a year ago.
Sure.
There was optimism at that time, but at that time, people felt that abhi kuch hua nahi hai. That particular degree of feeling that things are improving has improved in this year. I think a year down the line it will improve even further, because if India can maintain a 7.5% to 8% growth, which is where we are currently estimating, it's not a bad place to be, especially in a world which is not able to grow at all. In fact, I think that is the one good thing that we should celebrate. Fortunately, we are in a country which still has a lot of opportunities. And if you look at a lot of the mid-cap companies, a lot of the banks, 20-25% growth is coming along. So if you see the pockets where growth is there, things are happening, commercial space is being absorbed. In the last year, there was 14% growth in commercial absorption. All that is indicating to us that things are happening. Jobs are being created, companies are growing, companies are adding people. It's just currently not happening at a pace at which the expectation was, and part of that is being offset because of the export slowdown. The exports, so while we are doing the additions because of the Indian market growth, it is starting to cut
out of that
because of the exports, because a lot of jobs got created in the last 20 years because of the export sector.
All right, we have to take a quick break. We'll come back though, and we'll talk about what your advice is for regular retail investors at home this Diwali and how they should be approaching various asset classes. We talked about the fact that you believe a lot of the feeling of prosperity will be stronger next year. But in the meantime, this Diwali, when we look at the asset classes available to us, and I remember you have a very strong view saying you must have guaranteed fixed income over the long term to take the risk out of your portfolio when you're talking about retirement money. So in this particular bouquet of asset classes, real estate is not so hot this year. We can be sure of that. Gold has not really performed either. Within equity and debt, what is the advice you would give an average salaried person this year?
I think currently I would say Yeah, and I remember we spoke about this last year also, and we said, both equity and debt look well, and in the last 1 year, both have done equally well.
Yes.
If you look at equity and debt, I think we are at a very similar place right now, that both equity and debt still look promising because interest rates will come down. I think equity will do well. Equity is currently in a consolidation phase because earnings catch-up is being expected. So, but I would say at every opportunity in the market, I think increasing equity allocation, because the long term you want is equity, and I think debt, buying 3 to 5 year kind of debt is ideal for a lot of investors,
Okay.
because you can lock in that return, because India interest rates will go up and down. So if you take very long term view, that you do only with your retirement and pension money, but outside of that, if you have investments which are 3 to 5 years, then I would say currently bond markets look good, because I think given that interest rates are still expected to come down, there is some appetite in the bond market. But I think equity market.
Debt mutual funds, which are ideally the easiest way for any retail investor to access the bond markets, to access any sort of.
Through that, there are also a lot of retail issuances of bonds which are happening, which also are very good, because then there is no asset management fee on that. A lot of these bonds are traded in the market fairly well, so investors can access that. I'm very positive that things like REITs and all will come out, and that will give investors a good mix of some return and some capital appreciation. So as and when that comes, I think that will also be a good time, because I think real estate prices are still low.
REITs will then again still have an upper limit, an entry barrier that won't allow a lot of investors to access it. So it will still be an HNI sort of investment.
I think so, but I think it will be listed in the market, and a lot of people may be able to access it. I think those rules are being framed. But I think all these are the options which are there. So I think REITs will be where you have some fixed return and some upside. So I would say I think currently they both look good between equities and debt. I would say keep it in debt, and at every fall in the equity market, as it has fallen recently, keep on increasing your equity allocation.
We talked about, and rightfully so, what's happening with the IT sector and the job creation in the IT sector. Now, the correction of targets from the IT sector have made a lot of people, Infosys for example, there's a lot of people nervous. And again, I take responsibility for the fact that the media wrote some very, very harsh articles about how the IT sector is dead, which might have been unfair and premature. What's your reading of the IT sector? I'm asking for those people who have tech mutual funds, for those people who have, Infosys and TCS in their portfolios as stocks. It can't be the death of the IT sector.
No, I think IT sector is still growing, and it is trading at a fairly reasonable, PE multiples of about 14, 15 times, which is slightly lower than the market as a whole also. So I think it is fairly valued. It has now become a value sector rather than a growth sector in investment jargon, if I may say that. I still think there is a reallocation happening. People were overweight IT, but because of the global slowdown and all this, re-rating that is going on, I think you might see it sideways for the next 1 year, because there was overweighted. Because it was an easy place to hide. I think IT and pharma were easy places to hide for a lot of investors who are now reallocating. So in a way, I don't think the sector is dead. I think investors are reallocating, and hence.
So what is the new easy place to hide?
I think the domestic consumption-led sectors is what we think currently are the more exciting ones. We've already seen a huge thing in private banks and NBFCs. There has been a big rally, but I think they are still growing fairly well. We think things like cement and auto will do well, and they are also doing well. The consumption is starting to pick up. Capacity utilization in cement is very strong. So cement, auto, they are doing well. So I think they're enough.
2 years ago when we did this show, you said you were very bullish on the cement sector because of the infrastructure boom and the real estate and the construction, housing for all that the government is going to do. A lot of that has not played out. Is there a reason why we believe it will play out now?
I think it has played out in parts. So if you see the returns on the cement sector last couple of years have not been bad.
So, I mean, the larger plans of what would be constructed in this country in terms of infrastructure.
But I think you have to take a fairly holistic view. I think cement has a lot of entry barriers, not a lot of capacity is coming up. So our guys are still very bullish on that. But it's just an example about how to analyze. But I think for a lot of retail investors buying into good quality mutual funds, especially mid caps, we are, as a house, Edelweiss, we are very bullish on mid caps, because mid caps are still growing very well. 18, 20, 25% growth in mid caps in profits. It's still happening.
Is that performance that you believe can be repeated from the mid caps?
I think so. I think a lot of mid caps have gone through a lot of restructuring in the last few years. They've got their footing right, and they're really getting an opportunity to scale up. And a lot of them are under-owned. A lot of them are not as well known. So I think what we have seen in mid caps for the last 2-3 years may continue for the next few years as the economy is getting momentum. Because economy is, I think, if you are at 7.5, I don't think it's bad news for India as a whole. So when the GDP is growing at 7.5, somewhere growth is happening, right? And a lot of that growth, because the large caps, especially the the IT, pharma, maybe the PSU banks, maybe the telecom, they are not able to see as much growth. There is a lot of growth that is filtering down to the mid cap.
Is there a sector that you would stay away from in this market? That you would say that I would advise an average retail investor to sort of avoid this sector a little bit.
So, I think export oriented, you would currently be careful for the next at least a year because the re-rating is going on. I think infra and all I would still be careful, especially power and all, because power itself is going through this big change between conventional power and renewable power. And a lot of people believe that in the next 5-7 years, a large part of the power growth is going to be renewable power, not the conventional power. So you would be maybe a little bit careful on that, because when there are such big industry structural changes happening, you as an investor don't want to be in the middle of it. But as I said, other domestic growth, whether it's EPC companies are starting to do well. So companies which are India market dependent on growth, companies which have obviously a good management, a long enough track record, don't buy companies that you know only for the last couple of years. Companies which have been around for 8-10 years, who have gone through the ups and downs of the market, obviously corporate governance, good management team, all of that. If you want to directly buy into mid cap, otherwise there are some good funds out there. I think all the mutual funds in India have done very well. A lot of mid cap funds continue to do well. So investors are in a way spoiled for choice. You can invest it in some form or the other. But I would say at every market correction, increasing your exposure to equities, especially mid caps, might be a good strategy for long-term retail investors.
Right now, banks or NBFCs, which one do you prefer?
We are usually very cautious of stocks which are at 3 times, 4 times book in the banking sector or the NBFC sector, because at that time you have to grow very fast in the future. But I think any good company that is growing at about 20% a year, whether it's a bank or an NBFC, if somebody is growing at 20% a year, making about 16-18% return on equity, has a good management team, and it's available at between 1.5 to 3 times price to book, it can be a good investment. Anything more than 3, you always, whether it's a bank or whether it's an NBFC, you should be cautious. Then you should be more certain about where that company is. Anything which is under 1.5 time book value, also very often there is a reason, because maybe the earnings are not there or the strategy is not there. So you can calibrate it. But again, investors are spoiled for choice. There's a lot of good funds, and I always say that rather than try to do stock picking for a retail investor, because this is now a professional game, I think mutual funds are a good way of getting exposure. There are some good banking funds, good financial services funds offered by the mutual funds, which investors can try and get exposure through.
The real estate sector obviously is an asset class that Indians love and is going through possibly one of its worst festive season periods in a very, very long time. What's your advice to someone who's just looking to buy a home, who's currently holding on saying, if it falls some more, I'll buy it then? Is that a view that you agree with? What advice would you give people during this festive season?
I think I remember in one of the earlier shows, I had said this and I will say this again. If you're thinking of buying a home, then usually the best time is now, because I think that is not a financial investment. You're buying a great asset for the lifetime, and you're going to hold it for 20 years. Whether it falls by another 10% or 15% from here, how does it matter? Because for 20 years, that 10-20% gets amortized. I think currently mortgages are available. Real estate prices have not gone up for the last 3-4 years, which means in real terms there is a correction that has already happened. There's some good offers out there. So if somebody is actually looking to buy a home, I think this is a good time. And not just in Mumbai. I think you go to Delhi, NCR region, Bangalore, Hyderabad, Chennai, Pune. There are a lot of good quality, apartments and homes available, and so this is a good time to buy. I don't think people should try to time that market in that way. I think investing in real estate is always a tricky one. It's for somebody who has a lot of experience and time on that. It's a very illiquid asset class. If you know the builder and you are an HNI, you can take the risk, you can try and invest on your own. But we always said be careful to use real estate as an investment vehicle. But if you are using real estate to buy a home or your own office if you are an entrepreneur, I think this is a good time.
Yeah, my last question to you is this. I hope that all of our viewers have handsome Diwali bonuses in their hands this year. Now, automatically, when you have that kind of liquidity, there are a couple of questions you ask about it. Should I use this money to pay off a portion of my home loan and bring down my debt? Or should I invest it in a mutual fund? Which is basically you're trying to figure out if you can get one return to beat the rate on the other. What would you recommend someone does this?
I think investing is always going to give you slightly better return than what your home loan interest rate will be, because I think as we have seen in the market, markets on various time horizons, if you look at, you have got anywhere between 12-13% to 17-18% compounded return in equity investing in India. Even if you buy bonds in the last 1 year, you would have got about 12-13% total return on that. While your home loan rates will be 9-10-11%.
And likely to reduce.
And likely to come down, plus you get some income tax set-offs on that. So I think if you can service the EMIs and all that, it's always better to build an investment portfolio. In fact, that is the opportunity in India, or the irony is that everybody should be a borrower on one side and an investor on the other side, because they both are available. So if you're buying a home, take a home loan. I think it's a great product. There are some good, from banks and others, there are good offers available. You are borrowing for the long term. You're borrowing against an asset that is real value. You're not borrowing to speculate. On the other side, make some good long-term investments, which will give you, a better return. So having an investment portfolio and borrowing from the home, I think they both make a lot of sense. Investors should obviously do this carefully. Like if you borrow, you should be confident that you can service the EMIs. So I wouldn't repay the loan, but I would actually use it to make investments.
All right. We've run out of time on this interview, Rashesh. Thank you so much for spending time with us. It's a pleasure to chat with you every year, and I hope that we can continue to have these conversations in the future. If you're watching at home and you have a question for Rashesh or anybody else you see on this show, feel free to get in touch. I wish you a very, very happy Diwali. Enjoy your weekend. Thanks for watching.